In earlier session we discussed the days sales outstanding, which is the first component of cash conversion cycle. And now we are about to explain what is the days inventory outstanding and what is the motive of this component in cash conversion cycle. The days inventory outstanding isn't actually the measurement of the average number of days that a company holds for the stock to be resold to its customers and thus waiting for the cash. In other words, it could be defined as the average holding period and days that it remains unsold and waiting for reconversion to cash from sales. Always remember, the lower the period in inventory is considered better, as it releases the cash which is earlier tied up in the stock, and at the same time it also reduces the risk of obsoleteness. This lower period can be achieved by improving high inventory turnover. It is to be noted that high inventory turnover depends upon the respective industry. Now let's discuss why we take the average number of days while calculating the days in inventory. The reply of this question is simple: because the stock of the company changes throughout the year due to fluctuations in the sales, hence we view this as an average from the past. If we are really interested to have good amount of cash on hand for maintaining better liquidity position and smooth working capital management, then it could be done by improving high sales turnover that will reduce the inventory period and days, and thus have good chances to increase cash on hand and in a bank. But thing is that how to increase the sales of the business? The answer of this question is simple by emphasizing on following main areas. The first one is to adopt marketing mix strategy. The second step is you must have well-trained and skilled sales forces. The third one is your company must have good services environment. The fourth main area is by offering quality products, and the fifth one is to introduce some schemes on credit sales, like offering discounts and some good incentives to sales teams in the shape of commissions and bonuses on achieving targets. These are some key strategies that will certainly improve the company's performance. Now let's discuss what is the formula for days inventory outstanding. It is average inventory divided by cost of goods sold multiplied by number of days in a year.